And we're back at 7:46 this morning on Today's Money, what you really need to retire. If you're 10 years from retirement and your nest egg has taken a hit recently, what should you do? That question was asked in a recent Wall Street Journal article. Here with advice is Susie Orman, the host of the Susie Orman Show on CNBC. Hi, Susie. Good to see you.
Thanks, Matt.
This is an eye-opening time. You're a decade away from retiring. You may have taken a hit in the recession. You're starting to look at what you need. This is the time to plan. You got to get busy.
Yeah, actually, you should be planning all the way up until now. But all right, we have 10 years left. You don't know what to do. So let's start right into it. Listen, your major expense in life is your mortgage payment. If you own a home, my advice to you would be, after the point of the match in your retirement account, okay, get rid of your mortgage.
Pay off the mortgage.
Pay off your mortgage because you need more money in a retirement account to generate the income to pay the mortgage than if you just paid the mortgage off.
But you said in passing, let's make sure people heard what you said, don't stop contributing to your 401k plan, get up to the match point, and then take the excess money and pay off the mortgage.
And that's only if you plan to stay in the house for the rest of your life. But you get rid of that mortgage payment, by the time you retire, you're sitting pretty.
Second thing now, and this in some ways takes a piece of conventional wisdom and turns it on its ear. Usually you say, okay, you're 10 years away from retirement. You start to get out of the stock market and more into bonds. You say today's economy has changed that equation.
Yeah, you better be very careful. We're at very low interest rates. When interest rates go down, the prices of bonds go up. But when interest rates go up, the prices of bonds go down. Most people go into bond funds. They don't have a maturity date that says you're going to get your money back. If you go into bond funds now and interest rates go up, which they will eventually, you are going to lose money.
Just when you need to be building more money.
So I'm here to tell you this is not the time on any level to go into bond funds, especially if they're long-term maturity bond funds. Big red flag.
Okay, but you've got a lot of people out there who are still nervous about the stock market. So if you're telling them not to buy bonds, what should they buy?
So I'd like them to start to get a little calmer about the stock market in doing this. Stocks go up and down, but if you were to buy a stock or an exchange-traded fund that has a dividend on it, a 5, 4, 6% dividend, at least you have some cushion. If the stock or the exchange-traded fund goes down, you're still getting paid. So retirees today really should start thinking about looking into exchange-traded funds or stocks.
Just quickly, exchange-traded fund is a what?
It's like a mutual fund that trades on the stock market. It's far better than actually a mutual fund because of its liquidity, but it's a really viable alternative today, especially since interest rates are so low.
All right, so to recap. Pay off your mortgage. Be careful of your buying of bonds if you're 10 years away from retirement.
Especially a bond fund.
And look at these dividend-paying stocks and exchange-traded funds. 3 important tips for people who are 10 years and probably sooner away from retirement. Susie Orman, thank you very much. For more financial advice, you can catch the Susie Orman Show Saturday nights at 9 p.m. Eastern and Pacific Time. That's on CNBC.